On. Okay, super. Right, recording's ready. Welcome to the Investor Ready Funding Podcast, where we discuss all aspects of startup and scale-up fundraising and talk to both the businesses who've raised successfully and the investors who've chosen to inject their cash into early stage ventures. Today, I'm joined by Mathew Cushen, founding partner at Worth Capital, a London-based VC that invests up to 250k at seed stage via a monthly competition. Welcome, Mathew.
Hi.
So I've got absolutely tons of questions to ask you today. And really, first, I just wanted to ask you to walk us through your background and how you actually came to be in venture capital.
Sure. So I'm a retailer by trade. So I grew up really with Woolworths, actually. By the time I was 28, I had an eighth of the business. So about £250 million a year turnover and full P&L accountability. And then I got headhunted into the John Lewis partnership to re-engineer the supply chain for John Lewis department stores. And then it was about that time that, having kind of built up a little bit of a property portfolio, I started to invest, and I got really lucky on my first seed investment and turned, I think it was £58,000, turned that into 380,000 in just 4 years. So at that point, I thought, well, I might as well carry on. What could possibly go wrong? And of course, then I've understood that there's loads that can go wrong. But that kind of really gave me the bug, and also gave me the kind of play money to carry on investing.
Sure. And in terms of Worth Capital, can you just talk us through a bit more what the investment thesis is for Worth Capital and the approach to investing?
So myself and my mate Paul, we've always been investing together as kind of private angels. It's always been very hard for us to look at each other and think that the other one's going to have a success that we're not going to enjoy together. So we've been doing it, and we kind of found that, of course, we make better decisions if we make them together. It's more fun. We've got better chance of helping the businesses if we're using both our expertises. So about 5 years ago, we decided to, on the back of taking a kind of a proper review of where our portfolios were and where we've been successful and unsuccessful, we came out with some insight that we thought was quite interesting. And on the back of that, we thought we could innovate something in the market that was very different. And so we set up Worth Capital to do just that. And so that combines Paul's experience. He's been an entrepreneur since we were at college together. He's built up various businesses in the marketing space. And then my experience with big retailers. And then latterly, I've also been an innovation consultant. And in fact, I still do that. I still help very large businesses like IKEA, ABInbev, Coca-Cola Group, etc. So we kind of we thought our expertise would go well together, and we had this thought of having a competition as a way of finding different deal flow that everybody else was after. And so to get to answering your actual question, which is our thesis is relatively loose. What we look for is real innovation, but that can be product innovation, service innovation, experience innovation in markets that are underserved and high growth. So there's room for that innovation to find a foothold. That where the product, the service, or the experience has the basis to build habitual consumption. And what we mean by that is that the end user would come back again and again for more of the same. But we deliberately say consumption. This is not about necessarily only consumer businesses. This is also B2B. And for our mind, it doesn't really make too much difference if that habitual consumption is there. But the reason we go after that is that's the ingredients for building a loved brand. And a loved brand is really important, because that's how you build revenue, and that's how you continue to build revenue at various different stages of the business. But it's also we can increase exit value for our investors, because we're realistic enough that if you go in at seed stage, you're not necessarily going to sell out right at the top. And what you want to do is you want to leverage beyond just a multiple of revenue or a multiple of EBITDA. So if you've got brand equity in there as well, then that kind of accelerates your returns.
Definitely. Super. Thank you. And across investing, particularly over the last year or so, diversity has become a headline theme. And I know you've got quite a strong stance on diversity in investment. Perhaps you could just tell us a bit more about your thoughts on that.
Yeah, so our point of view is pretty simple, and it has led us to very strong results on diversity. But the point of view is very simple, that we've got no positive discrimination when it comes to where we put our cash. But equally, we take a huge amount of effort to remove bias from where we put our cash. And then that results in us having a much stronger record, both on gender, regionality, and also ethnicity than anybody else that we've come across within the industry. So let me give you examples of how that kind of manifests itself. So first of all, our basic premise was to make gathering deal flow as inclusive as possible, because if we make that easy for entrepreneurs, then that gives us more quantity. If we make it so that we go beyond the London bubble, we go beyond the networks that often the financial services industry relies on, then we will get to see different businesses, and we will get to see businesses from parts of the country and from different communities that wouldn't necessarily come forward to traditional fund managers. So that was the kind of fundamental reason we had our competition. And it's kind of interesting to us that whereas 65% of our kind of funding ends up in London in the southeast, actually 70% of our funding has ended up beyond London and the southeast. So we also have the competition because one of the things that Paul and I realized when we reviewed our portfolio is that the more disciplined we were about looking at our deal flow, the better the decisions that we made. And so we set up this monthly competition in part to gather deal flow, but also to really discipline us. And so we have this regular rhythm that we go through. We've got 6 different stages to the competition. Although it's a monthly competition, it takes about 2 months to distill. Regular disciplined stages that we go through. We always keep our promises to the entrepreneurs as to when we're going to get back to them, so we don't leave them hanging. But it disciplines us to go through a rigorous process. As part of that, we also get external judges on board. So that helps to eliminate some of the biases that we have. So we try to make sure they're from different backgrounds, because unfortunately we're 2 white, middle-aged, grey-haired blokes from the southeast, like pretty much every other finance house out there. But we're very conscious that we have biases, and we do lots to eliminate them. The other thing that we do is we actually say ditch the pitch. We think pitching is a really bad way to select investments. I think it's a bad way. I'm an innovation consultant. It's a bad way to look at ideas. People tell me it's a bad way to pick up dates. There's all sorts of ways that pitching isn't actually that helpful. And I think one of the we were looking at that purely from a investment perspective, but also we subsequently realized that actually that probably helps on gender as well, because blokes are often, just generalizing, but blokes are often full of the kind of the confidence and bullshit, where the communication and the bluff and bluster can actually overpower the true essence of the business. Whereas women often, not always, will be a bit more considered and a bit less forward. So we think other ways other than pitching are better to equalize the skills of entrepreneurs. And, and it's interesting that whereas only 9% of our kind of funding goes to businesses with female founders, 40% of our funding has gone to businesses with female founders. And then also on ethnicity, we can't even find a benchmark on this, unfortunately. But 19% of our funding has gone to businesses with ethnic founders, non-white founders, which we imagine is probably a much higher proportion than the industry.
Yeah, it's quite hard to get a lot of funds to actually commit to what their percentages are at the moment. So I'm not surprised you find it hard to find a benchmark. But it's really interesting to hear how ditching the pitch is actually helping to change the balance of investment as a.
And look, maybe it helps, maybe it doesn't. I mean, we did our numbers because we encourage our entrepreneurs when we work with them to really analyze their performance and look at data to see what's happening. And so it'd be a bit ironic if we weren't doing that ourselves. And we just kind of stumbled across these numbers, and then we asked ourselves, okay, well, what was driving that? So there's a little bit of post-event rationalization here. So I don't know whether the pitching thing is helping or not, but what we do know is that it helps us make better investment decisions, and that's what we're about.
Super. Okay. We obviously can't ignore the other big event of the last year of the pandemic. How's it impacted investing so far from your perspective? And do you feel that there's going to be longer term impacts?
Yeah, so I think what's been really what we realized. So the first thing we realized when we could kind of see it coming out of China and when it was starting to enter Europe, particularly Italy, we sat down with each of our businesses and we thought about the potential impacts. And we were very much focused there on the short term. And, and frankly, for 2 or 3 months, we only focused on the immediate fallout. But then we started to lift our heads up to the horizon and started to see that actually we needed to think about this in 2 different ways. And I think this has gotten a bit lost within the investment community, that there's 2 very different things that are happening that affects your view of a business within and beyond the pandemic. One thing that's happening is short-term headwinds and tailwinds. So that there are businesses that were affected hugely by lockdown, and in a really negative way. There were businesses that were helped by lockdown. So there's headwinds and tailwinds, and actually working out which of those a business was going to face and how much of those they were facing and kind of what those were is actually pretty important. And separating that from the second dynamic, which is the long-term systemic changes that changes in behavior are bringing about. And I think that for a lot of investors, they kind of miss the fact that those are 2 completely different things. So to make that a bit more real, we actually did pretty well through the pandemic. It's a really hard thing to say, but we were, in a lot of ways, the pandemic, as everybody says, is kind of accelerating trends that were already there, and we were kind of following those trends. So we don't have any physical retail, but we've got a lot of direct-to-consumer retail that's been doing well. We've got some medical stuff that is remote that's doing well. So actually a number of the trends were accelerated, and we kind of did all right out of that. We've got one business, Bedfolk, which is direct-to-consumer bedding, and absolutely was at the eye of everything that people wanted. It's got a proposition that's all about nesting and wellness and the home. Exactly at the point where everybody was like looking to invest in their home because we were showing off our home behind us. It was direct to consumer, so benefited there. And frankly, its kind of main competitors within the category are department stores. You've got Debenhams gone, you've got House of Fraser in turmoil, you've got John Lewis, which are struggling. And so huge kind of positives. They've grown, they were already growing very fast. They grew even faster, we're not kidding ourselves that that tailwind is going to turn against us at some point. But actually the underlying proposition is super strong and we've made the most of it. And that business has grown from, we first invested 2 years ago, it was at $6,000 a month. The first SEIS investment that we made. In just 24 months, that's grown to 400 grand a month.
Wow.
So, I mean, unbelievable stratospheric
Yeah.
growth. And we don't think that's going to slow. We don't think that's going to reverse at any point. But we do think that the scale, the
rate of growth will.
Growth. And that's because great tailwind. But actually, the longer term systemic change, okay, there will still be a shift from, and they'll maintain a shift from physical to online shopping, but it won't be as marked. You know, I think that the high street will bounce back. It will look very different, and there'll be less shops and there'll be less volume through shops and everything, but it will bounce back. There's a pent up demand there. We had another business, Weekly 10, or have another business called Weekly 10, which is about measuring sentiment and engagement within organizations and measuring performance. And that, as soon as the pandemic broke, actually kind of struggled for a couple of months because, you know, every business out there was thinking about the here and now. But we said, look, this is gonna change, and what they're gonna need to do more than ever is understand sentiment engagement.
Yes.
Working remotely. So let's basically shift all our marketing activity over to that. And then we had a spot of luck, which was only 3 weeks before the pandemic hit. The business had gone on to an integration with Microsoft Teams, and then we benefited hugely from Teams becoming such a prevalent.
So prevalent, yeah.
So that's where we had a kind of a headwind turning into a tailwind, but then fundamentally, I do believe there will be a shift in remote working. It will reverse back a little bit from where we are now, but then it will find kind of happy medium.
Yeah, not fully, but definitely a shift back to the way things were.
So
in that direction.
So that's where Weekly 10 is well set up for the future as well. But you kind of got to strip out the turmoil from the last few months and just look on the long term there. Although having said that, that's grown like Billy-O as well. I mean, that in 12 months has grown to a 400 grand annual recurring revenue in just 12 months. So that's doing well as well. So anyway, there was a long-winded answer to your question, but I think that the key thing, separate out two things. Pandemic lockdown induced headwinds and tailwinds that are relatively short term, and versus the conditions that are caused by systemic changes to consumer behavior.
I know you invest at seed and not at pre-seed, but one of the things we've seen in the stats over the last year is that pre-seed investments really suffered, whereas seed and Series A is actually been relatively okay, a bit lower, but relatively okay, as investors kind of stepped back to support their existing portfolios and as they took a more risk-averse approach and said, we're only going for ones that are showing that they've got revenue that's working already. Do you think that that's going to continue much longer term, or do you think with coming out of lockdown, hopefully finally in fully in June, that we'll start to see people willing to take more of a punt on the very early stage businesses?
Yeah, I think actually we're already seeing that. So I mean, I don't particularly like the terms pre-seed, seed, Series A, because I think they're massively confusing. I think if you ask one person to define them and then ask another person to define them, they'll put different values on them. They'll describe them in financial terms. They'll describe them in business maturity terms. I think they're pretty pointless terms. But as far as, if you look at early stage, and we do SEIS and EIS, and we're generally the first in on SEIS into a business. Sometimes there's some there's some family and friends and angels in there already. But whereas that was very difficult during the calendar year of 2020, in the first quarter of 2021, or the last quarter of the tax year 2021, then we started to see SEIS kind of freeing up a little bit. And actually, come March, it was actually pretty good, SEIS.
Yeah.
So I'm confident it is freeing up a little bit. I think it's interesting when you kind of correlate tax advantaged investing, SEIS and EIS, with a market that has got completely nothing to do with it, which is like the normal kind of public equities market. They've got no correlation at all, except that there is a kind of a bit of a sentiment driver there. SEIS and EIS is the last cash out of the investor's bottom drawer. And it's only when they feel sort of like relatively confident about everything else that's going on, do they feel that they can really kind of like dip into that bottom drawer. And that's what we were seeing in March. They were like, well, actually, maybe things aren't as bad as
they're starting to see that confidence level coming back, definitely. Exactly. Yeah, super. Okay. So apart from that kind of burgeoning trend back to early stage investment, are there any other kind of current trends that you're seeing, particularly in startup investment, whether it's sector focus, amounts of raise, where money's going, in terms of early or late?
I think it's very difficult to tell. I think there's some great services out there, like like Bohurst, for example, is really good for looking at where cash is going, but none of them are, I think, particularly reliable, and therefore you get a lot of competing views that are sometimes contradictory. I guess from what we're seeing, I think there's still some overblown sectors. We invested in a fintech business 6 weeks ago. That was the first fintech business that we've invested in since we set up Worth Capital, because we think it's a massively overblown sector, and we really struggle to find valuations that work. And generally, we often find businesses that have got great solutions that are desperately in search of a problem to solve. And we often find in fintech that the customer acquisition costs bear no relation to the potential lifetime value. You can see that with some of the huge businesses, like some of the challenger banks, etc. But we found this business, which is an e-current account product for the contingent workers and students coming into the UK, of which there are 1.5 million a year, and it's really difficult for them to set up a bank account before they get to and this account can be set up before somebody arrives in the UK, and it solves a massive problem for recruitment agencies that are recruiting people like construction workers or agricultural workers or care workers or nurses or supply teachers. Solves a big problem for them, so they're very happy to market that product for us. So that basically removes our cost of acquisition. So how do we get onto that? So I think fintech is generally overblown, but there are some gems in there, and we think we found one. I think basically I think tech is overblown. We don't ever talk about looking for tech. We look for markets that have problems that need solving, and look for that have got great insight into markets. As soon as somebody describes a fintech product to us, or a health tech product or whatever, we kind of roll our eyes and think that this is somebody that's trying to sell us a solution, and what we want to understand is what the problem is.
Sure.
And similarly, actually, when people get, we get turned off by anybody describing themselves as a blockchain business or an AI business or whatever. That's just a means to an end. And we're much more interested in what is the value for the consumer or the business, from buying the product.
Yeah, I mean, we actively tell our clients not to describe themselves as a blockchain business, because 9 times out of 10, actually, investors are a bit scared of blockchain and they don't quite understand it. And if you tell them it's a blockchain business, they go, no, sorry, I'm not interested. But if you tell them it solves this problem in this market, and we use some intelligent tech to help us do it, oh, that's fine. Then it's a much different reception. So yeah, completely agree on the blockchain front. And those are kind of, I guess those are trends of investments that have happened. Obviously, you've got this huge deal flow coming through, or potential deal flow coming through each month of 100 or more businesses wanting to raise. Are you starting to see any different kinds of emphasis on the deal flow that you're getting, or is that still kind of the same sort of mix as you've seen the last couple of years?
I think it's very similar. We still get plenty of food and beverage ideas. We have to be pretty blown away by a proposition to be interested in food and beverage, because it's such a difficult space to get traction. That's not to say that we don't look at those, but we haven't invested in a food and beverage idea for a long while. I think we get probably a few more SaaS businesses, SaaS B2B, which generally can be interesting. That can be a good commercial model. Again, we don't invest in commercial models, we invest in solutions for people. But yeah, they can be interesting. We probably are a few more of those. I think we get a few businesses that are kind of desperately trying to justify their idea through a COVID lens, which I think is a bit pointless. And we're very
somewhat short-termist. Yeah.
And we're very kind of conscious that we've got some businesses that have had great traction in 6 months, but actually you've got to question if that's something where, as I was describing earlier on, there may have been a tailwind. The question is that sustainable, or was that just a kind of lockdown friendly business? Yeah,
just a lucky happenstance.
Yeah.
Okay. So we've talked about the fact that you kind of don't necessarily find new investment opportunities; they come to you through your competition. What's the kind of stages that happen in the competition? You talked about the 6 phases that you've got.
Yeah, so first up, we make it super simple for everybody to enter. So it's only a 2-page summary or a 2-minute video. And we love it when it's a video, and we love it when it's just a founder talking about their proposition, because that gives us a sense of whether they can articulate that proposition in a way that makes sense. So that's super easy. I mean, it literally can take 5-6 minutes to enter the competition. That also means that makes it easy for us to distill that first stage. So generally it's just the 3 of us, Paul, Hayley and I, that look through every entrant, and we look through that independently. And then we just tick cross maybe. And funnily enough, the meeting I had just before this was for our May competition. And we spent a couple of hours, and we didn't talk about those that we all ticked, and we didn't talk about those that we all crossed. No point kind of just ending up in violent agreement with each other. What's interesting is where we tease out where one of us has seen something that the others have. What is that? And are we all enthusiastic about the same? Or can we get enthusiastic about the same thing? So that brings in different perspectives and gives us a bit of a kind of a safety net. And then from there, we ask people to give us more information. And that we've got a series of questions, but we just say, if you've got a business plan, send us the business plan, and then review these questions, and you can tick it's in the business plan. We're not asking anybody to,
rewrite it all. Yeah.
And again, we actually prefer to see people's own documents rather than fitting into a like a box ticking exercise, because we want to see how people can articulate. We want to see how their brand comes to life. But there again, if somebody hasn't got a pitch deck or a business plan, they can answer our questions. And they can also answer our questions if if the question doesn't happen to be in their pitch deck. So then again, we go through those independently, and that's generally where our guest judges come in as well. And then we have 5 criteria, which we score out of 7. There's a little bit of science behind using 1 to 7 rather than 1 to 10. So we score 1 to 7 on each of those 5 criteria. We weight that according to the criteria. Then we average that across all of us. And then we've got the scores, but that's just stimulus for us as to kind of where everybody is. And then we have a day where we look through all of those, and then we decide who we want to take to the next stage, which is a telephone interview. And then we kind of dig into some questions that aren't quite clear or some things that we're interested in. Then we come back together again and review the results of those interviews, and then we decide who we want to take to our final stage, or the final stage of the competition, I should say, which is a half day with Paul and myself. And that's a great chance for us to really kind of dig into the business and dig into the chemistry with the founders, to dig into the strategy, into the market, into the marketing plan, etc. And at that stage, we're normally starting to come up with, some of our ideas as well. And so, ideally, everybody should go away from that meeting thinking, oh, wow, there's like some real kind of chemistry and we can add a load of value into that business as well. And then we consider, and then, generally, we pick 1 business a month, but sometimes it might be 2, sometimes it might not be any. Then we have a meeting with our fund manager. We're not FCA authorized, so we don't manage our fund. What we do is we make a commercial recommendation to our fund manager as to where the fund could invest. They give us a really hard time about our rationale, and then they may or may not decide that would make a good investment for the fund. And then following that, there's a little bit more technical and commercial due diligence, just to kind of make sure that everything is as it should be.
Yeah, super. Okay, it's really interesting to see the the way that it filters down. And I often do talks to groups of early stage founders, and there's always a real sense of shock in the room when I say to them, potentially a VC gets 50 decks a week to look at, and they might, they'll filter out 45 straight away, and then they'll properly look at 5, and they might talk to 2, and then across the whole of the year they'll only invest in 4 to 6, and there's a real really, that's how small the odds are of being the ones that make it through. So I think it's super important that people understand the level of filtering that goes on to get to the final opportunities that do get the cash.
Absolutely. But there we go. I also think that actually, funny enough, VCs ought to kind of take some responsibility as well for helping people to understand that, and also to feedback. So it really winds me up that entrepreneurs rarely get feedback from VCs. Even if they do, it's pretty cursory. So within that process that I just described, those that get knocked out in the first stage, we haven't asked them to do very much, and we haven't done a huge amount, and therefore we haven't got a huge amount to go on. So they get an email, and they get an email on the date that we say that we will send them an email, so we don't leave them hanging, but we don't give any kind of personal feedback at that stage. But from that stage onwards, we give bullet point feedback for a number of things that we found really positive, and a number of things that we found weaknesses, so that the entrepreneurs get a sense of, and we don't ask for them to agree with it or not, and they may very well not, But the point is that that's the impression that we got, and that should help them the next time they talk to them.
Yeah, definitely. And I think one of the other things that would almost help reduce this massive traffic funnel in a lot of cases is if more VCs were super clear about what their investment thesis is and what makes them turn down a company, because then they wouldn't have to wade through 50 decks a week. They might actually only get sent 25 because they're the 25 that really match to their investment thesis. Whereas I think at the moment, some of them are very wide and woolly in terms of what they say they might invest in. But when you get, behind closed doors, they've actually got really specific criteria, but they don't share them. And it just adds to this kind of traffic and bombardment of let's just send our deck to anybody just in case.
Yeah, I think you're right. I mean, I think there are some VCs that actually have got woolly criteria. And that's kind of fine. And actually what they're saying is, well, just kind of make it real for us and we may or may not be interested. And I think that's fine. But I agree with you. If a VC comes back after the event and says, well, that's just not a sector that we invest in, then might as well have described that up front.
Yeah, exactly. Or where they've got, we don't invest in below $1 million ARR or things like that they don't say publicly. I think that could be improved on a lot. Okay, so
but investors have FOMO as well. We're just like everybody else. We've got a fear of missing out. So, I do have some sympathy that nobody wants to make their criteria so narrow that they miss out on stuff. But at the same time, they do have a responsibility to stop wasting people's time.
Yeah, absolutely. Definitely. And what makes talking about those stages that you go through and the things that make you definitely tick something straight away, what's an investment approach or an opportunity that makes it something that really draws you in? What's the kind of thing that really grabs you when you get a new opportunity to look at, that makes you go, this is an immediate tick, not a maybe?
Yeah, so a new and a different and a compelling insight into a market is really kind of turns us on. So, I mean, it's very difficult to innovate if you see a market in exactly the same way as everybody else does. It's like, I mean, this is what problem big businesses have. They use their, what I would term, foundational insight, the kind of same data that they're always using at, and the same data that their competitors are using at, and then think that they're going to have some kind of really interesting ideas off the back of it. For innovation, you have to see things in a different way. You have to have different insight to get differentiated ideas. So, a kind of a compelling and empathetic sense of a market is always really useful for us. And then if that market feels of sufficient scale, then that's also interesting. If the idea feels kind of properly new and different, so real innovation. If the founder can articulate that in a kind of compelling kind of way, and that doesn't mean that you've got to have a great brand, because nobody has a brand at this stage. All they have is a name and a logo, but it just means and people may not even have that, but it just means being able to describe what you're bringing to your customer in a way that A, is clear enough to make sense, and B, has a little bit of sizzle around it, because that's something that you need to be able to build a brand. And then also, of course, we're interested in the team and what they've done before, and whether there's some kind of evidence that they can make shit happen. Because the best idea in the world, but unless you've got people that can actually knuckle down and make stuff happen and have got a reasonable amount of resilience and tenacity, then they're not going to get past the bumps in the road.
Yeah, definitely. And it's think the team ones, I saw a startup that will remain nameless recently, but it was basically compiled of a group of very senior people who had all been at very senior levels in big corporates and had decided to set up this startup, and they had a huge board and virtually no doers in the organization at all, and you could see that already it was kind of not getting the momentum that it should, because they'd got the makeup of the team completely wrong. So even though you'd look at the names individually and go, wow, their experience is incredible, their ability to create momentum didn't exist because they had lots of decision makers and no people to actually push the pedals around.
I completely agree with you. We're actually really kind of apprehensive about kind of big business experience and going straight from that into their own startup. I did it and I failed, and I call it the hubris of big corporate. And so I set up a retail business. I was at John Lewis. I left a really big job, multi-million pound, budgets. And I set up a retail business with the intent to have 150 stores. And, and I should have taken a much more experimental approach. I was building the business for 150 stores before realizing, what would work in one. And you see that a lot, and you end up seeing more about structure and process than you do about customer and insight. So yeah, I'm with you. I'm hugely wary of that.
Yeah,
it's not to say we don't like people with industry experience. It's just, what have they done to transition from big industry to
to cope with the culture shock of
spending our investors' cash.
Yes, yeah, definitely. And one founder described it to me brilliantly. He said, I'm actually having to do my own IT support and I have no idea what to do, because he'd gone from having this massive team that supported him to being on his own and being a founder. And he was like, I've got to make my own tea. And it was a complete culture shock. So getting over that and getting into the can do, turn your hand to anything type approach is definitely an adjustment. Okay. Obviously you've got the competition mechanism, so maybe it's slightly different for you guys than perhaps other VCs, but do you find that people approach you early to try and build some relationships before they actually need cash, or is the mechanism of the competition such that people tend to just arrive at your door at the point when they want to apply and they don't come for earlier conversations?
We sometimes they might try to do so, but we will kind of direct people to the competition. What we do though is that if we see somebody in the competition that we think could be interesting but they need to do some stuff, we'll put that into our feedback and we'll say, let's continue the conversation. So in Bedfolk, for example, they were in a competition maybe 8 months before we invested in them, because we had the conversations, we couldn't really actually find the right deal on valuation, and I think they needed some more time to kind of prove some points in their business, and they also needed some time to talk to some other investors, but we just continued the dialogue. So the competition isn't necessarily a route to instant equity funding, it's a route into a conversation with us. Another business, Vitru Health, actually, it was a year between them entering the competition and us investing. We had some pretty strong feedback actually about the market that they were looking for, and they took that on board and they kind of changed their marketing approach and actually started to prove out some of that, and then we invested.
Yeah.
So although it's different, the competition is our entry point.
Yeah,
it's similar in the sense that sometimes we will have a number
drives those developmental conversations
with.
Yeah. Okay. And we've talked about what makes a yes, but what's a no? Not necessarily when you first get the deck, but maybe even up to the stage where you're doing the half-day workshop with them. What are the kind of things that make you go, actually, that's not one for us? I know there's the kind of basic criteria of it's not sufficiently innovative in its market, but is there particular founder behavior or things that you've uncovered that become big no's?
Yeah, so a lot of what we're testing out is the chemistry within the founding team, and then also with us. So we're looking for good balance within the team. We're looking for good kind of relationships within the team. We're kind of trying to sniff out where are the risks to that relationship. We're looking for how charismatic people are, because these people are going to need to lead teams. They're going to need to find customers. They're going to need to influence suppliers. They're going to need to get more investment down the line more often than not. They need to be able to carry themselves in a certain way. One of the criteria we added recently, actually, to our kind of description of what we look for within a team is charm. Frankly, we don't need to hang out with people that we don't want to hang out with. So we don't. So if during the course of the process we find people that have some kind of sense of entitlement, or aren't willing to put in the hard yards, or don't treat everybody around us with the kind of respect that we would expect, whether that's the receptionist we always talk to the receptionist in our shared office afterwards, not least because we're often sharing samples with them and stuff like that. They're our testing panel. But yeah, we'll get a point of view from people if people are being rude when they come in or whatever. So we take a very 360-degree look, and we also do a little bit of kind of pseudo psychometrics to test out people's behaviors and attitudes. And that's the thing that generally sort of like kind of doesn't work for us is the test.
Yeah.
Generally, when you look at the mistakes we've made, both within Worth Capital and 10 years angel investing before that, generally it's been the team where we've failed up.
Yeah, decided to just go ahead and ignore that one niggle that's telling you no, and that turns out to be the issue that knocks it all sideways. Yeah. Okay. Let's talk about valuations. What are the kind of key challenges for you when you're evaluating a startup's valuation that they're putting forward?
Well, I think the challenges are varied. The real problem is that you can't take a purely scientific approach to an early stage valuation. And I think, sometimes people make a valiant attempt. Our worst case scenario is when an accountant has tried to get in on the act and is advising an entrepreneur, because they're trying manfully to kind of make it scientific, and it's all bullshit built upon bullshit. What we want to do is get to a place where the only valuation that counts is the one where somebody is willing to invest and somebody's willing to give up equity at that price. So that's what we try and find. The framework that we use to have an objective conversation about it is just a little equation, and it's evidence times momentum times potential leads to the valuation. And the time signs are important, because if any of those three things are missing, then it should actually be zero. You're going to want a balance of evidence, momentum, and potential. And all too often, you get some ridiculous valuation based upon pure potential with zero evidence and zero momentum. That work for an investor, however early stage. And what we want to see is a decent story across those three different elements. So that's the kind of conversation that we have, and we're not looking to shaft an entrepreneur. Why would we? We're going to have to work with them for 5 years. So if somebody ends up disgruntled about the price of the investment when we first went in, that doesn't serve our purpose at all. So we're never looking to do that. What we're looking for is a fair valuation based upon the very, very, very considerable risk. I think that's the other kind of tricky thing from the entrepreneur's perspective, because of course the entrepreneur thinks that their idea is a surefire winner. They've got they've got blinkers on, and we kind of need those blinkers. We need belief, and we need confidence from the entrepreneur. But at the same time, they've got to recognize that as a VC, we are only expecting some of our investments to live, and only one or two to do really, really, really well. And everybody thinks that theirs is the one that's going to do really, really well, but it doesn't work like that. So the valuation has to work within the context of a portfolio, not just within the context of one business.
Yeah, definitely. I know one investor who always asks founders, tell me why your business will fail, just to force them to recognize that it's very possible that it will, and to make sure they understand how that could happen. So yeah, important question. Okay. Excuse me. And then once you get into that kind of, people tend not to talk very much about the legal process portion of the deal, the going through the term sheet details and the due diligence. Lots of the focus in startup world is about, getting in front of the investors and doing the pitch, but actually deals quite often fall apart going through the due diligence phase. And what are some of the things that you typically see either delay the deal massively or actually make it fail when it's going through that stage?
The main thing really is kind of intellectual property, and where that's either, could be as formal as patents, or it could be kind of who has ownership for design and stuff like that, particularly if there's been other founders involved. So we dig into that, and that can unearth problems. There shouldn't really be, at the very early stage, there shouldn't really be too much that can go wrong. I mean, basically, it's if there's any promises that have been made, then regardless of whether those promises are material or not, they are material to the relationship. So if we in due diligence find that those aren't what was expected, then that will raise a big red flag about the trust that could be had in the relationship. So yeah, so that's really where it can go wrong. I mean, as far as the legals go, look, lawyers will always make work for themselves, so that's something we kind of guard against. We always put a shareholder agreement out there. We want people to take legal advice on it, but at the same time, we don't see any reason why they should change it. Because it's pretty much the same shareholder agreement that's been used for multiple dozens of investments before. So but lawyers will always want to make work for themselves, but it's just a question of kind of managing the legal process, really.
Yeah,
it's harder even after the first raise, when you're going into an investment where there's already existing investors, or where other VCs are following on from us. That's where it starts to get, trickier, because you've got different parties to manage. But it shouldn't really be a big deal. And it's just all about communication, like most things. It's just as long as everybody's kind of clear and are doing things quickly.
Yeah, then you can get through it.
Yeah, exactly.
Definitely.
Lack of momentum kills deals, because just something else will come up in the interim. And if people get bored, if investors get bored, they'll just like, well,
yeah, why are we hanging on for this one? Definitely. Okay, one final question to close out the episode of the podcast. What's one thing that you would love all founders to do when they're preparing to raise investment?
I think about the story that they're looking to tell from the investor's point of view. So I would hope that no entrepreneur would dream of telling their brand story to a potential customer from anything other than the customer's point of view. And that's exactly what you're doing with an investment story, is you should be telling the story from the investor's point of view. So get into their shoes and think about, well, what is it that they need to believe, and what is it that they're going to need to overcome to believe in your business. And then I think that leads you to a strong story about the market, a strong story about your innovation, a strong story about your potential commercial model, even if it's not there, and a strong story about your team. And then you'll kind of end up with the right kind of components to sell the business. But you have to get into your investors' shoes.
Definitely. That's one of our key tenets in the whole investor ready approach is you have to be able to assess your business objectively from an investor's viewpoint, rather than just standing on the inside going, it's amazing, because they'll be looking for lots of gaps, they have lots of questions, and you've got to be able to make sure that you can give them the ability to knock out all of those concerns and worries and make it easy for them to say yes. So
not necessarily in the first instance. You need to get them excited first, and then need to then deal with the other things. But so it doesn't have to all be in one go. And that's the other part of being in their shoes, is being empathetic to the way that you communicate with them at the appropriate time with the appropriate materials.
Yeah, definitely. Thank you so much for your time. And we will finish the episode there.